Good afternoon or good morning to everyone, depending what the case may be. My name is Frank O'Brien. I am a benefits educator at Wespath Benefits and Investments. And I am joined today by Todd Creviston, a fellow benefit educator, and Cheryl Hatcher, who is our senior benefit plan specialist. Today, we are providing to you the fourth of 6 installments of our retirement webinar. The prior webinars have been recorded and posted to our website. This webinar will also be recorded and posted to our website. And there are 2 more dates where we will do this webinar. The first is Tuesday, May the 10th at 10 o'clock Central Time. The second or the last for the series will be Wednesday, May 18th at 2 o'clock Central Time. As you're looking at this webinar, you will see on the toolbar to the right-hand side, if you click on attachments, we have provided 5 documents for you to open, download, and review at your leisure. And also there, you'll see a question box. Please use the question box. As I go through the first part of today's presentation, Todd and Cheryl will be behind the scenes monitoring the questions. Halfway through, Todd is going to take over the presentation, and then I will jump onto the question box and continue to come back at you, give you the answers that you might be looking for. So we will get started today, and I'll have my colleagues confirm that we are in good order and that moved. Just give me one moment, please. Okay, thank you very much. We're all set. So for today's agenda, we will go through the retirement process. And even though we're kind of getting late in the game here, we'll still kind of go through the steps that should have been taken or maybe are still in the process of being taken. We'll go through the Wespath retirement plans. We'll do a refresher, kind of an overview of the plans. And then I will continue on speaking about the lifetime income options that you can receive from the Crsp, the MTP 65%, pre-82 if you're long tenured. We'll speak about the annuities, and we'll speak about the cost of living adjustment that you can elect to go along with that annuity over time. At this point, we'll transition over to Todd, who will begin to go through your account balance options. You'll hear about several, including Life Stage Retirement Income, the program where you're asking us to derive an amount of installment payments for you. He'll go through housing allowance, benefit processing, resources, and matters such as those. So the retirement process. The 2022 applications should be made using benefits access. Several years ago, we transitioned from paperwork, which can be riddled with errors, not unintentionally, but still a lot of errors, to using our benefit access portal for you to make your elections. The latest version of benefit access, we think, has really eased the navigation and the selection or election process for you to determine the benefits you want to receive or make the determination to not receive any benefits and just leave things as they are. For those who are wanting to receive retirement benefits 7/1/2022, you need to indicate your choices no later than Thursday, June 30th at 3 o'clock Central Time. But please don't wait until that time frame to start making your elections. You can start making them now. And if you make elections and you put it onto benefit access, something happens, because we are in a very strange day these days, something happens, you want to cancel it, you are able to do that. But any transactions that you have pending at this time, June 30th, 3 o'clock, will be processed and processed for July 1st income payment stream. We'll begin by looking at the provisions for retirement under the Book of Discipline. There is the normal retirement provision, normal retirement, fully accredited for benefits. This is age 65 or 40 years of service. And the key word there is or. If you're age 63 and you have 40 years of service, you can retire under the normal retirement provision. If you're 65 and only have 15 or 20 years of service, you still retire under the normal retirement provision. We have an early retirement provision that's age 62 or 30 years of service. Again, if you're age 60 and you have 30 years of service, you can retire under the early retirement provision. If you're 62 with 15 or 20 years of service, you can retire under the early retirement provision. And I'll talk about some of the impact of early retirement. There's a mandatory retirement age of age 72. And for those who may be going into a retirement appointment under the 20-year retirement rule, so maybe you're 55, you have 20 years of service, just note that if you retire under that provision, you have to wait until you get to age 62, the early retirement age, before you can start making your benefit elections. What do you need to do this year if you are retiring? Well, one thing you want to do is verify on benefit access that all of your personal information is correct. Your name is spelled right, your address is correct. If you're changing addresses, make sure you do that in a timely manner. But you also want to check the information we have for you on your spouse. Again, name, date of birth, social security, etc., to ensure that all that information is in good order. You also want to verify your clergy service record. You can generate a clergy service record on benefit access. Why is the accuracy of your record important? Well, I'm glad you asked. Certain benefits get calculated using your service time. The Crsp defined benefit that you'll hear about a formula soon, part of that formula is your years of service. For those long tenured and have pre-82, part of the calculation is using your years of service pre-82. Many may be eligible for the death benefit in retirement through the Comprehensive Protection Plan. Well, that's also based on years of service for eligibility. But lastly, we think this has been your ministry, and making sure that it's fully articulated on your service record, we think is an important thing. So please take a look at that record. You want to review and update your life stage investment management profile. This is a program we have where you ask us to derive this is the program that we have where you ask us to tailor an investment election for you using the Wespath funds. And you want to project your retirement income. We have tools on benefit access where you can run a benefits projection. You can run a retirement readiness tool. You can look at that clergy service record, your spouse's information, your information, how you are set up in life stage investment management, but also your beneficiary designations. You want to make sure your beneficiaries are in good working order. If something happens to you, you and your spouse, something tragic, and they are not in good order, it will go to your estate, probate court, takes years to come out. It may not go in the direction that you want it to go in. So please, as part of what you're looking at now and setting up for retirement, look at your beneficiary designations. And not just at Wespath, but other things that you have, your wife's retirement and pension and your life insurance, where beneficiary designations can be attached. As far as health benefits are concerned in retirement, it's a very important topic, and we think you should review that with your annual conference if you have not already. There's a checklist of items. Again, we're kind of long in the process right now, but just as a refresher, notifying the Board of Ordained Ministry within 120 days. Notify your bishop, notify your cabinet, but we're not too long in the process for you to make a call to EY. EY Financial Planning Services, the partner that we have, Ernst & Young, where they provide comprehensive, holistic household financial planning services for you with no out-of-pocket costs. This year, and attached to this webinar, we generated a retirement checklist. Please download this, use this as a tool to continue to mark off where you are in getting yourself ready for June 30th or July the 1st. Having gone through some of that housekeeping, now we can talk about income and where it will come from. First, we'll start by reviewing the Wespath retirement plans. This table here is what I like to call the employer provided retirement plans for you. It's kind of a walk down memory lane. We have the Clergy Retirement Security Plan. That is what's in place right now. And you'll see two buttons there, 2014 plus and 2007 to 2013, and I'll explain why. We also have the Ministerial Pension Plan. And we have the Ministerial Pension Plan. That is from 1982 to 2006. And then for those long tenured, we have the pre-82 plan. Within the Crsp, we have the monthly defined benefit, a formula benefit, a traditional pension that you will receive. And there is an account balance that's also provided to you. With the Ministerial Pension Plan, or MPP, there are also two facets to this plan. It's an account balance plan where at the time of retirement and annuity election, 65% of your account will go and purchase an annuity. But the other 35% is an account balance for you to determine how, when, and how much retirement income you want to derive. And then there is the pre-82 plan. This will generate a monthly benefit and is a life and survivorship annuity. The amount of the survivorship percentage is determined by your annual conference. But we're not finished yet. There is also the voluntary plan, the UMPIP, or United Methodist Personal Investment Plan. Altogether, we have the employer-provided plans and the UMPIP. Taking time to look at your lifetime income options and how they are derived from the Crsp, the MPP, and the pre-82 plan. And these will come to you in the form of an annuity, and they are lifetime income options. You and your spouse cannot outlive these options. But with the lifetime income options, once you and your spouse have both passed, then no further benefit is provided to anyone. As I stated, there are two pieces to the Crsp, a defined benefit piece and a defined contribution piece. So it's two retirement arrangements working in tandem. Looking at the defined benefit, we want to start there because it's a little bit more complicated. It's a little bit more involved. You need to understand the annuities that you have available to you, COLA options that you have available to you. And once you have made your elections and you begin to receive the income from these annuities, these decisions, the annuity election and the COLA election, are not revocable. These are irrevocable elections that you make into pay status. You can't come back and want to change one of the features of that annuity. It is not a balance. You will not see your Crsp DB amount on your quarterly participant statement. You'll see the Crisp DC, MPP, it's an account balance, UMPIP, but this part you will not see because it is a formula, not a balance. And in the formula, we multiply three factors together. There are three variables in the formula. The first is the denominational average compensation, or DAC, or DAC. We love our acronyms. The other part is a factor, a retirement factor, either 1.25% or 1%. And then the credited service during the period of time that you are deriving the annuity from. So again, clergy service record being in good order. What is this DAC? Well, it is the denominational average compensation. It is the average compensation of all full-time appointed clergy over the number of full-time appointed clergy. For this year, the DAC is $75,570. This is what gets used in the formula. For those retiring next year, we already know the 2023 DAC of 76,221. We always do it a year in advance. And then we have the factors. When the Crsp first rolled out in 2007, the retirement factor was 1.25%. The General Conference of 2012 reduced that to 1%. And lastly, in regard to the credited service, we'll look at the first service period time. July 1st, 2007 through December 31st, 2013, with an assumption we're making that these are all full-time appointments. For that, you have 7 years. And now we're just doing the math. We're taking the DAC at the time of your retirement, so 75,570. In this time frame, the retirement factor is 1.25%. And then the 7 years of full-time appointed service in this time frame. And we're multiplying the DAC times the retirement factor times the years. We generate an amount, we divide by 12, and it generates, in our example here, $551 per month. We also have the second period of service. And for today's purposes, full-time appointed through June 30th, 2022, 8.5 years of service. We take the DAC, now we have the 1% retirement factor, the 8.5 years of service, we multiply them together, we generate an amount, we divide by 12, we have the $535 per month. Now we add them together. We have the two time frames, we've done the calculation, we have the 551, the 535, that comes up with an amount of $1,086 per month. But Will other items impact the amount that you receive? And the answer to that is yes. Decisions that you will have to make. For example, the survivor spouse benefit. It could be a life in 70%, 85%, 100%, and that will impact the amount. And then the cost of living adjustment that you elect for the CRSP, for that annuity, a percentage of increase year over year. For CRSP, it's a 2% minimum, but you'll hear about other options momentarily. And then early retirement. If you recall, early retirement was age 62 or 30 years of service. So we want to point out to you that if you go into retirement appointment at early retirement, there is a reduction in the amount of the CRSP defined benefit you will receive. So for today's purpose, a very simple example. We have someone age 63, has not had 40 years of service, and is retiring exactly 2 years early. For each month of early retirement, there is a 0.05% reduction in the amount of benefit that you will receive. So that comes to 6% per year, and in our example, that is a 12% reduction. So you can see here that on our example, it comes down to $9.56. If you're going into early retirement, a couple of things to note for you. One, this is a good reason to have a conversation with EY Financial Planning, because you want to understand on the long term as well as the short term what the impact of getting that early reduction may be. But you do have the option to defer receiving your CRSP DB until you attain age 65. And if you do that and you make your election, we'll do the calculation as of your age 63 retirement appointment, but you do not experience any of that reduction. So if you're retired, if you're 63 this year and you wait 2 years to get the benefit, to get the full benefit, we're going to use the DAC for 2022, the 75,570. We stop counting accrued service time and the retirement factors. So there's some consideration for you whether or not it's marginal in terms of getting an early retirement, or there may be a larger impact, and you might want to consider having a conversation with EY or your own financial advisor about how those numbers will look for you over the long term. We have the defined contribution component of the CRSP. The defined benefit is a formula benefit, but alongside that formula benefit, the employer has been contributing into an account in your name. 2% automatic required non-matching contribution. And then for those of you, and hopefully all of you, that are contributing at least 1% into the UMPIP, an additional 1%. So that's 3% that's going into the account balance in your name to supplement your retirement benefits. Here you are directing the investments. There's a defined contribution account. You have access to the Wespath family of funds for these accounts. You can direct your investment if you're comfortable with the investment markets and kind of understand things and you keep your eye on things. You can determine how you want your accounts to be allocated. Or take advantage of Life Stage Investment Management, that program where we're tailoring an investment allocation for you based on several factors: your age to retirement, life expectancy, married or not, and we continue to manage that too through the long haul of your retirement. You'll hear about how this is available as cash distributions in retirement. You can roll over the money to UMPIP. We kind of recommend doing that because the UMPIP is the plan that has all these options available to you. You can roll it over to another retirement plan. But again, you want to talk to an expert on this because you want to make sure that if you roll it to another retirement plan, you don't lose the housing allowance tax exclusion advantage that you have. Here at Wespath, your distribution's eligible for the housing exclusion. In a commercial vehicle, probably not available for the housing allowance exclusion. You can leave it on account, let it continue to grow until you attain age 72, at which time the IRS steps in and said you need to start taking required minimum distributions. And in the context of this part of CRSP, your account balances, if anything is remaining in the account balances when you and your spouse pass away, that will be provided to your named designated beneficiaries. So again, hopefully in good working order. Moving along, we'll go to the Ministerial Pension Plan, or MPP. Again, there's two things happening here with MPP. It is an account balance now invested in Wespath funds using Life Stage Investment Management. At retirement, and upon your election to receive an annuity, 65% will go get that lifetime annuity. But what about the remaining 35%? That is an account balance. That is an account balance that is available to you to take as cash distributions. You can self-manage how you're receiving those dollars in retirement, or you can use life stage retirement income, which Ty will review with you down the road. So when we're talking about all of these annuities, let's take a moment now to talk about the annuities that are available to you. The Crsp DB annuities, as well as this MPP 65% annuity. So what is an annuity? Simply, it is a series of payments that is provided to you, you and your spouse over your lifetimes. Again, you cannot outlive these. For our purposes, these are a series of monthly payments. All of the annuities provide lifetime of income for you and your spouse if elected and you are married. There are 6 overall annuity types that are provided. 3 are life and survivorship, and 3 are single life annuities. For the life and survivor annuities, you can see that there are 3. Life in 100%, life in 85%, life in 70%. You can see the amount payable to you, and then you can see the amount that would be payable to your surviving spouse upon your passing. Looking at the first one, we consider this to be the default annuity option, but you can make the other elections if you so choose. We have the life in 70%. So you go into retirement, you're getting your annuity, you have the COLA, you're moving along, you pass away before your spouse would receive 70% of what you were receiving. You can elect a life in 85%, so upon your passing, it's 85% that would go to your continued annuitant or surviving spouse. And there is also the life in 100%. So as you can see here, as the survivorship percentage is going up, the amount that is initially payable to you in retirement is coming down, but the amount that's being provided to your surviving spouse upon your passing is going up. And in that last example, the life in 100, it is the same amount to you and to your surviving spouse upon your passing. There are also 3 single life annuity options. You can see here we have a life only, life with 5-year certain, and life with 10-year certain. On the right-hand side, you can see that the amounts are payable to you are higher than what you saw in the life and survivorship annuity. And that is because this is paying just one life. Life and survivorship is 2 lives over time. So actuarially, it reduces the amount. For a single only, you get a higher amount because upon your passing with a life-only annuity, no one receives any further benefit. But we do provide for you the option to elect a life with 5 years certain, and I'll review a life with 10 years certain annuity. And what that means is when you go and you elect your annuity and you choose a 5-year certain, let's say you are single and you are supporting a niece or nephew through college, and if something was to happen to you, you wanted to make sure you could at least fulfill that support through the course of their college career. You choose a life in 5-year certain. That means over the course of 5 years, someone will receive a benefit. You're moving along 3 years into your retirement, you pass away. For the remaining 2 years, someone will receive that benefit. But once we get to 5 years, no further benefit is provided. In the context of a 10-year certain, it could be health-related matters, it could be age differentiation between yourself and your spouse. You could do a 10-year certain. In this instance, the concept's the same. You have a 10-year window. You're moving along, let's say in year 7, you pass away. For the remaining 3 years, your designated beneficiary would receive those payments for that 3-year period of time. But after that 10 years has passed, no further benefit to anyone. So you have these options that are available to you, and you can use the benefit projection to model how the income will look depending upon the options that you choose. But that's only part of the puzzle. We have the annuity election for you, or the forms of annuity, but we also have the COLA, the cost of living adjustment. It's an annual increase in your annuity amount. You can choose a 2% increase, a 3% increase, 4 or 5. And in regard to your MPP, the Ministerial Pension Plan, 65% annuity, you can elect a 0% COLA, basically have it be a straight fixed annuity over time. Does not apply to Crsp, it's got to be 2%. MPP, you can elect a 0%. Now, does the COLA election impact the amount of the benefit? Well, yes, it does. And here is how. And we'll show it to you illustratively. So let's say you've taken a life in 70% annuity with a 2% COLA. And here you can see that the amount's going up 2% per year. But maybe in your planning, you say for one of the annuities, the Crsp or the MPP, I want to have a 5% COLA, so I get a 5% increase over time. The thing to note there is the initial amount of benefit that is payable to you is reduced. Now, this is illustrative. These numbers are not real. The numbers on the left and the age is on the bottom. For illustrative purposes, though, you can see there is a reduction, a kind of a significant reduction in the amount that you receive going into retirement. But over time, you can see that you are receiving more benefit in the later years, not the last years, but later on in retirement, you're receiving more of a benefit. So let's say you know you have longevity in your family and you're thinking about paying for medical bills later in life. This is an option that is available to you. As I indicated for MPP, you can do a 0% COLA. And you can see here, it is the highest amount that you would receive going into retirement, but it's flat and it's steady all along. It may be part of your financial planning, retirement planning that you're doing to say, okay, I want that to come out at 0 at the higher amount, knowing it'll level off, but I have other streams of income coming later on, so you can make that determination if you so choose. Again, EY financial planning available to you for that conversation. And then we just illustrate what the 3% or the 4% would look like. You can see the amounts that you receive come down against that 2% COLA, but over time, there is a crossover threshold where you're receiving more benefits than that 2% COLA over time. So to summarize it relative to MPP, you can leave on account until age 72. Again, the required minimum distributions will kick in. You have annuity and COLA options that are available to you to choose from. You can take the 35% of the account balance and wait on the 65% and roll over that 35% to your UMPIP. So what you can do is you can say, I don't want yet to receive my 65% annuity. I'm going to defer that. But while I'm deferring that 35% of the account balance, I want to roll that into UMPIP, and I want to either self-manage or use life stage retirement income to get income from that account while I'm waiting for, let's say, a market recovery. Right, we're back in market volatility, a market recovery to where you're more comfortable electing that annuity for the long haul of your retirement. You can roll it over to another retirement plan, but again, a little warning flag about the housing allowance, making sure that where it lands, they can declare it is eligible for the housing allowance exclusion. And you'll hear about other distribution options. Lastly, in the context of the employer-provided retirement plans, we have the pre-82 plan. It used to be called the Minister's Reserve Pension Fund. Again, years of service in this time frame come into play. There are two calculations that we do to determine the amount of pre-82 benefit you will receive. On the right-hand side, we have the formula benefit. That formula benefit, again, years of service in the time frame. But we also have the defined benefit service money. Back when the pre-82 was the active plan, your employer was putting an account in your name to fund that future retirement, to fund that future annuity you were going to receive in retirement. And this is a great story on the time value of money. That account has grown all through the years and decades to an amount now where when we do the calculations, we determine which of the two amounts we want to provide to you. This will provide lifetime monthly benefit. We use your years of service. We use what's called a past service rate. A past service rate is a dollar amount that is determined by your annual conference each year. And we multiply that. But we also look at the account balance and run it through the annuity process of the pre-82 plan to derive an amount of benefit. So in this example, and it's just an example, we have someone with 3 years of service. The past service rate is $750. We derive $22.50, divide that by 12. We have a monthly amount of $187.50. But let's say that your account balance has grown to $75,000, and that's not uncommon. We then convert that into the annuity, and that generates an amount of $312.50. At this point, you don't have to make any decisions. We're making the decision for you. We will give you the higher of the two amounts. And even though in our example, the spread may be very big and you may never cross over back to that past service rate, each year we still do the calculation. We look at your years of service, we look at the current year's past service rate, and if there's ever a time where that calculation will derive an amount higher than the annuity from your defined benefit service money, we will switch it over and give you the higher of those two amounts as well. This is a benefit that's paid for life. It is a fixed annuity. There's no COLA attached to this. If it's single life, there's no refund, no period certain options upon your passing. There's no further benefit. And depending upon your annual conference and the election of your annual conference, there is a survivorship percentage that's also provided for the annuity. It can be 70, 75, 85, or 100%. Again, that is determined by your annual conference. So that concludes this part of the lifetime income portion. We're now going to transition over to Todd, who will talk about the options you have with your account balance plans. Thank you, and take advantage of that question box if you have not yet so far.
Thank you, Frank. I need to switch over my screen. How does that look?
I see that. You want to give it a click? Yep. Okay, all set, Todd.
Muy bueno. Perfect. Thank you so much. Hi, everyone. I will talk about the account balances that I think Frank has already started to outline. I'll talk a little bit more about EY, fantastic opportunity. And then I'll also talk about when you're going to start to receive your benefits, as well as some additional resources that are available to you, particularly if you're retiring this year. I will cover, whoops, here we go. So let's chat a little bit more about the account balances. And these are typically a defined contribution account balance. You'll see that Crsp, you have an account balance associated with the Crsp program. That is made up of contributions from your employer. There is a 2% non-match of your annual plan compensation. And if you're contributing at least 1% into your UMPIP account, then you'll receive an additional 1% match for a total of 3% of your plan compensation. And we hope that everybody's contributing at least 1% to their UMPIP account. The other account balance that you have available to you is that remaining 35%. So when you choose to begin that MPP annuity, that 65% becomes that lifelong monthly payment that Frank talked about, and you'll select an annuity for that. The remaining 35% is available to you as a cash balance. And the cash balances are there to offer flexibility, because you could choose when and how you'll begin, and how much you'll receive in distribution. And Frank talked about rolling it out into another investment vehicle, potentially rolling it into UMPIP and then taking a distribution from there. If you don't need the income when you retire, you could let that balance remain until the IRS requires you to take that minimum distribution. So the account balances are there for the purpose of flexibility, and you're in control of that flexibility. Now, the retirement plans are designed to replace your income. They're designed to replace your income, so you have income in retirement. But should you be in a circumstance where you don't need that income, you can take it as you need it, or take it at some point in the future. The third account balance that you have is the UMPIP account, and sometimes we call this the voluntary plan. Everything on the left-hand side of the screen is a mandatory plan. You are participating in that as a qualified clergy person. The right, UMPIP, that's the voluntary plan. Let's cover a little bit more about UMPIP. So UMPIP is an account balance. It's considered a defined contribution account or defined contribution plan. We like to shorten things up and say a DC account. And that just says that the plan will accept contributions by plan sponsors and employers So some folks on the call might have a contribution from their employer into their UMPIP account. Most clergy that contribute, they're contributing based on their payroll deduction. So your contributions go into your UMPIP account. And then Frank, myself, and Cheryl, our contributions also go into UMPIP. So as an employee of Wespath, UMPIP is our retirement plan. You have options on how to direct your investments. You can choose your funds and determine how your contributions go into those funds. That's called self-managed. That works for some folks. I did that initially when I first started, 10 years ago at Wespath, and then I learned more about what was available to me a couple of months after I started, and I learned that Life Stage Investment Management was available, and that places the account management of your defined contribution accounts on autopilot and manages your account while you're in active service, but also into retirement. So there are 4 ways to contribute to your UMPIP account. And the first is on a before tax basis. I have to say a majority of the participants in UMPIP are doing so on a before tax basis. The other opportunities include an after tax basis, on a Roth basis, so it's a Roth contribution to your UMPIP account. Roth contributions have been around for only about the last 4 or 5 years, and a Roth contribution is a form of after-tax contribution. And then a rollover. And the neat thing about rollovers is that the government, the IRS, allows you to move your previous employer's retirement plan. You're allowed to move it from your prior employer's plan into UMPIP. And doing that is really easy. You'd use the incoming rollover form for that. And the IRS allows the IRS qualified plans to be portable. So that's the 401k, a 403b, and a 457b. But you can also roll over a traditional IRA into your UMPIP account. And to do so, that would just, you'd use the UMPIP or the incoming rollover form, really easy to do. I had a couple prior employers, this goes back before before turn of the century, before 2000. I had worked at the University of Illinois Chicago for a while, and then I had a prior employer's plan before I got to Wespath. And about 3 years ago or so, 3 summers actually, coming up on 3 years this summer, I rolled both of those prior employers' plans into my UMPIP account. And that just decreased the amount of paperwork that I needed to look at, because each quarter I was reviewing 3 quarterly statements, UMPIP and then the 2 prior. In doing so, now I only have to review 1 quarterly statement. So it reduced, it made my headache from that go away. For 2022, here are the before tax and Roth combined contribution limits. So everyone can contribute $20,500. For those folks like myself who are over 50, you can contribute an additional $6,500 in catch-up contributions for a total of $27,000. When we do those consultations, so later we'll invite you to sign up for a consultation with a benefit educator. We typically review the contributions into UMPIP and chat about that. In a lot of cases, for clergy getting closer to retirement, they're kind of upping what they're contributing to their UMPIP account, which is great to see, because that will help to increase that balance and positively impact retirement in the future. If you're younger, I would encourage you maybe 5, 10, 15 years out, if by chance you came onto today's call, I would encourage you to take a look at what you're contributing and contribute what you can reasonably afford, and then make a plan to increase that over time. Like my wife and I just paid off a car. Yay, that was a happy, happy day. But the next month, we decided to do something else with that money. We decided to up the contribution to the UMPIP account by 1%. And then we're also saving a little bit of that money for repairs on the existing car and saving that extra money for a down payment in the future. So there is possibility for some found money in your budget. You just need to be aware of when it comes around. So that was contributing to your UMPIP account. Now we'll talk about the distribution in retirement. Like all of your account balances, if you don't need the money come July 1, you could let it sit invested with Wespath until required minimum distribution, or RMD. So that's the first option. The second option is just taking a distribution. And there's a couple of ways to do that. You could do a full lump sum distribution, a partial lump sum. So partial would be maybe 5,000, 10,000, maybe take the vacation, maybe update the kitchen, maybe go on that vacation. But it would be taking a chunk of your account out. The next distribution option would be setting up cash installments. And Frank talked about this a little bit earlier, and he talked about life stage retirement income, and he talked about a little bit about self-managed. So the cash installment, the monthly cash installment, self-managed, that means for those who are retiring this year, you'll go into your account and your benefits access account, and you'll tell Wespath how much you'd like to have each month, whether it's $500, $1,000, that choice is up to you. And then you'd manage that on an ongoing basis. The life stage retirement income has been around for probably about 10, 11 years. I know it predates me. I've been here since April of 2012. And life stage retirement income first was designed to calculate a monthly payment for you that would calculate that payment in a safety zone so that there was an excellent probability of a payment lasting a lifetime and a goal of increasing that payment each year, almost like that cost of living adjustment. But we have to say, because it's an account balance, there is no guarantee, but we are allowed to say that being in life stage retirement income does offer excellent probability of providing a payment for a lifetime. So that's the first thing that life stage retirement income is designed to do. I've got a couple slides to talk about two new options beginning in spring of 2020 that the retirees this year will be able to take advantage of and participate in. And then with all of your account balances, any remaining balance upon the participant's death or the retiree's death, that remaining balance is transferred to the beneficiaries. So make sure you keep your beneficiaries up to date. Primary beneficiaries are typically spouses. Secondary beneficiaries are typically children. Children tend to move. They tend to change their phone numbers and their addresses. You're able to do those updates in your benefits access account. So a little bit more on required minimum distribution. The top is pretty much the paraphrase of the IRS definition. So the required minimum distribution is to begin no later than the April 1st of the following year after the participant turns 72. After presenting on this for about the last 4 or 5 years, I believe I finally have that definition in my head and I understand it. The good news is Wespath partners with you, we team with you, and we help to keep track of that for you. So if you're not taking a distribution from your account, you're getting close to 72, Wespath is going to send you a communication that tells you how much you need to take out. That's great news. Your required minimum distribution will apply to all of the defined contribution accounts. We've talked about those, the 35% of MPP, Crsp, and UMPIP. And then once you begin taking an RMD, you'll need to continue taking that RMD, and the prior year's, December 31st balance is used for that next year's required minimum distribution. If you haven't begun the other benefits at that time, MPP annuity, Crsp DB, and pre-82. You'll need to do that at that time. And IRS Publication 590 does a great job of providing more information, more details about required minimum distributions. But fear not, Wespath will help keep track of that for you. EY is also another wonderful resource to talk about. They love COLAs, they love required minimum distributions, and they also love talking about the housing allowance exclusion in retirement. Wespath is required to withhold federal tax on partial and full distributions as well as RMDs. And you see the amounts there. So Wespath withholds 20% for partial or full distributions and 10% on required minimum distributions. Each year, you'll get a 1099 from Wespath that will show how much you received in income in retirement from Wespath. You'll also be able to see on that 1099, it'll show you how much was withheld in taxes. So now let's move to life stage retirement income. I mentioned life stage retirement income does three things. The first thing it tries to do, it tries to optimize your income in those cash accounts. It tries to optimize it to last a lifetime. Life stage retirement income is optional. You don't need to be in it, but we would suggest to take a look at it, particularly for those who are retiring this year, and even having a conversation with an EY financial planner. That life stage retirement income will calculates that monthly payment for you, and it considers your account balance, your age, if you have a spouse, your spouse's age, as well as your risk tolerance. And at the bottom there, that's the goal: provide that monthly payment for you and your survivor and your surviving spouse to last a lifetime. So it's designed to help you maximize your income in retirement and minimize the risk of running out of money. When you opt into life stage retirement income, your account balance is then managed by Life Stage Investment Management. They work together. They're like twin brothers or twin sisters. As part of selecting your benefits, you can set aside money for larger expenses or unexpected expenses. It's like a reserve account. So you could set aside money, set money outside of that life stage retirement income payment calculation that you can go tap into at a future date. Now we'll talk about those two new features for 2022. The first is a Social Security bridge. That's the goal there is to delay taking Social Security past full retirement age. By delaying Social Security past your full retirement age, it increases your Social Security benefit. The second piece is longevity income protection. Essentially, you have the option to purchase an annuity in the spring that you're retiring. So up until June 30th at 3 p.m. Central, you have the ability to purchase an annuity, and Wespath has partnered with Pacific Life for that. And that annuity will then provide guaranteed income beginning at the age of 80. So guaranteeing some income later in retirement. For everyone who's retiring this year, your benefits access account currently has the ability to provide modeling on what each of those look like. And you have the ability to adjust the amount of income or the amount of your cash balance. You have the ability to adjust the amount that you want to commit to the program from your consolidated cash balances. So it's a really terrific modeling tool. So with the Social Security bridge, what we're trying to do is build a bridge using your account balance at Wespath to defer taking your Social Security. So let's say deferring your Social Security from full retirement age of 67 to 70 years of age. life stage retirement income will provide the amount of Social Security income that you would have received from Social Security. Okay, so you'll be made whole by receiving what you would have received in Social Security from your life stage retirement income. So all you need to do is tell Wespath the amount that you'll need an amount that you'll need that you would have received from Social Security, and then life stage will provide that additional income until you take your Social Security. So if your retirement age is 67 and you defer it, you will receive 8% more for each year, and that goes for 8% per year for each year you defer. So if you defer it from 67, that's your full retirement age, up to 70, that's an 8% increase for each year, for a total of a 24% increase in your benefit. That increase in the benefit ends at 70, but you don't have to wait until 70. You could take your Social Security at 69 or 68, that's up to you. So that Social Security bridge is designed to replace the income that you would have received in Social Security, and you'd receive that from life stage retirement income. So that's the second thing that life stage retirement income does. The third thing that life stage retirement income does is this other option, and you have the ability to purchase an annuity. It's a deferred annuity, so you'd purchase it prior to retirement this year, and that income, that annuity, those payments would begin at the age of 80. So this would provide a steady stream of guaranteed income for later years in retirement. The way that this will work is that you will elect to purchase this longevity income protection at the time of retirement, and then those payments will begin at the age of 80. I have a visual that I think does a good job of further explaining these two pieces. So this example includes both the Social Security bridge, deferring taking Social Security or delaying taking Social Security, and then also that longevity income protection. So as you could see here, that your retirement begins, that would be the early years of retirement. You're receiving your payment from life stage retirement income. So this would be from 67 to 70, and then at the age of 70, sorry, that's always a bit tricky, you'll see that the life stage payment decreased. So the reliance on that life stage payment, that amount was leveled down because now you've begun Social Security, you've deferred or delayed taking Social Security, so that benefit is now larger. And that life stage retirement income payment has been leveled down to help protect that balance into the future. The next piece, sorry about that. The next piece is at the age of 80. So at the age of 80, we see that the life stage payment has been lowered even more, because now that longevity income, that guaranteed annuity payment has begun, and you're still continuing to receive Social Security. So in this example, you see that they've selected both of those opportunities, the Social Security bridge and then also the longevity income protection. So when elected together, they can help maximize your retirement income and help your account balance to last a lifetime for that long haul. So that the benefits of life stage retirement income, the goal is to optimize your retirement income, to minimize the effect of any market fluctuations on your monthly income, and to minimize the risk of outliving your funds, outliving that cash balance payment. So that advanced modeling tool is available. It's in everyone's account who is retiring this spring. It's a really neat tool. It does a great job to show what your payments would be based on the amounts that you're using or the amounts that you're wanted to commit to the program. And it will help you kind of land on what's best for you. We also recommend having a conversation or two with EY. They've been fully trained in the 2 additional options for life stage retirement income. So they are a wonderful resource. Some action steps. If you haven't created your My Social Security account at ssa.gov, we would suggest that you do that. I would set aside a little bit of time for that, for you to do that. Some unencumbered time, maybe 20 or 30 minutes. To access your account, they're going to be asking you some security questions that might surprise you. They might be in depth. They might be asking you, which of the 3 addresses have you ever lived at? And so it might be a little bit thought-provoking. So have some time set aside to be able to do that. You can log into your benefits access account and review your life stage investment management profile, see where that's at. Understand all of your sources of retirement income. So if you have any retirement plans or any resources outside of Wespath, EY can help bring those in and to give you a more complete picture. If you're married and your spouse also has retirement income available, you'd want to consider that. EY can also talk about those to give you a household retirement picture. And then we suggest contacting EY and setting up that consultation. If you are considering rolling over a prior employer's retirement plan or rolling over a traditional IRA, you can contact Retirement Services to get that rollover form. So now let's move to the housing allowance exclusion. This is how the housing allowance exclusion in retirement. And what it really is, it's a wonderful tax break for retired clergy in their retired status with their annual conference. This is available to other denominations. It's just not a UMC tax break, but it's available to other denominations as well. The amount that you can exclude from income each year is based on these 3 statements, these 3 scenarios. And I like to start off with saying it's the least of these 3 scenarios. The first one is relatively easy to come by, and that's the amount that's designated as the housing allowance. That generally comes from your annual conference. Each annual conference, they'll pass a resolution designating the housing allowance. I haven't been to every single annual conference. However, I've only heard of annual conferences passing 100%, meaning 100% of what you receive from Wespath can be excluded from taxes. That's a great number. Couldn't be any better. However, we need to do the other 2 scenarios as well. The second is the amount that you actually expended for housing. And I should say this is for your primary residence. So the amount you actually expended for housing includes a mortgage payment, interest, principal of that mortgage payment. If you're renting, your lease payment, your rent payment, includes utilities, property taxes, renter's insurance, homeowner's insurance, all of those expenses. We have the housing allowance exclusion worksheet that's in the handout section that Frank talked about. You can pull that down. That provides an outline of all 3 of these scenarios that you need to work through, as well as the different expense buckets that you can keep track of to determine how much you expended in housing. It also includes furnishings and utilities, so quite a wide array of expenses allowable. The third part is the third scenario is the fair rental value of your home. So what your home would rent for, your primary residence, what it would rent for the period of time, including utilities and furnishings. And I've heard of local clergy, or I've heard of clergy using a local real estate agent or a local appraiser. And to help come up with that number, you'd want to have a letter from that appraiser to document the amount that you were using for that particular area, or for the fair rental value. So you want to keep a bona fide, you want to make a bona fide attempt at keeping track of all three of these should the IRS ask you to do so, ask you to prove your housing allowance exclusion. So this slide is a little difficult to read. However, if you pull down that housing allowance exclusion, it's a PDF, you'll be able to read it just fine. And then from that standpoint, you can print it out. This outlines all three of those scenarios that I talked about. You probably also want to give this to your tax preparer and make sure that your tax preparer is aware and comfortable with the housing allowance exclusion, how it was come about. And like I mentioned, EY can chat with you about that as well. So a quick example. In this example, the person is retired from Wespath. They received $24,000 in pension. 100% of that is designated. That's easy to come up with. So it's 24,000 would be that first scenario. The second is they've kept track of all their expenses, utilities, furnishings. You can even keep track of Windex and paper towels. In this example, they spent $20,000 in housing. They had an appraiser, a local real estate person, come up with a fair rental value of their home, and it was $21,000. That includes furnishings and utilities. So we know it's the least. The housing allowance exclusion is the least of those three. So in this case, the housing allowance cannot exceed $20,000. The math here is pretty easy. We just subtract the housing allowance, which was $20,000, from what you received in pension for that year, $24,000. That means the taxable amount is $4,000. A wonderful tax break. This is available to retired clergy. It's not transferable to the surviving spouse unless that spouse is also retired clergy. There's a note on the back or the second page of that handout, the housing allowance exclusion worksheet, that provides some sample text that you can use when you submit your form. It just calls out that you know that you excluded income because you are entitled, because you are entitled to that exclusion because you're retired clergy. So there's just a couple of sentences toward the bottom of that. So one of the things that we always encourage clergy to do is to run a benefit projection. And when the benefit educators meet for the benefit education consultations, which I have a link in a couple of slides. When we meet, we typically run projections, and this is something that's available to you as well. You'd go into your benefits access account, you can run a projection. We just like to call out that it's a changeable estimate. There's a number of things that go into those projection numbers. And first is account growth. It's assumed 4% growth in MPP, 7% in CRS or in the DC accounts, Crsp, DC, and UMPIP. There's an assumed increase in annual salary, and then you could choose your annuity type. Frank talked about the different annuities: life in 70, life in 100 for married clergy. He also talked about COLAs, that cost of living adjustment, the amount that monthly payment goes up each year. You can run you could run projections based on a different annuity type and a different cost of living adjustment. And then you can also have that life stage retirement income calculate a payment from your defined contribution account balances. So it will give you an idea of what your lifetime income looks like for a particular date in the future, and also your account balance income. You could use life stage retirement income for that account balance distribution. Here is what the benefit projection looks like. This is just a demo. So up in the right-hand corner, you'll see that it says benefit commencement date. So you can change that date. Then the next section is lifetime income. And then you'll see the benefit associated with each of the different lifetime income plans that you're available, that have available to you. So if you have, if you had service prior to 1982, like in this example, you'll see the pre-82 payment, the MPP payment, and then the 2 service periods for Crsp. And then there's a subtotal for that. So that's the lifetime monthly income can outlive. If you're married and you select a joint annuity, that would actually cover 2 lifetimes. The next, or the middle section, is the account balance. And this is using life stage retirement income to calculate that monthly payment for you. You'll see there's a payment associated with each of the different defined contribution accounts available to you, down for a subtotal. And then there's a subtotal, there's a total at the bottom that includes the lifetime income payment and the account payment. The other piece we like to call out is the estimated income replacement ratio. And that doesn't include Social Security, but you can add probably another 33% on top of that. So that's the amount of income that you're replacing in retirement. Financial planners like you to be around 80 to 85%. If you're higher, that's even better. So now the next big question is, when do the payments begin? So that initial benefits processing takes a couple days. We like to say that it's estimated to be on the 3rd business day of the month. Wespath is annuitizing millions of dollars, and we need to make sure that we get it right. So that initial payment is delayed a couple days, a couple business days. And then with July 4th, that typically impacts that first payment. So for those folks who are retiring this year, your first payment will be on July 7th. Beginning in August, you'll receive 2 payments. The first payment that you'll receive each month is the annuity payments, or the lifetime income, and that'll arrive on the 1st business day of the month. The cash installment payments will arrive on the 2nd or 3rd business day of the month, and those are done via EFT. That's a transaction that gets deposited into the account or accounts that you entered in the process of selecting your benefits. We like to call out that as a retiree, there are still death benefits available to you. Everyone on the call would be in the right-hand column of this table. So there are benefits for a retiree, retiree spouse, retiree surviving spouse, and a retiree child. EY is a wonderful opportunity. I actually was presenting live to a workshop in the first week of April, and a participant asked me a question, and he told me that his financial planner told him something, and that was contra. What he told me was contra to everything that I knew and everything that I'd been trained on. And I said, well, that's different than from what I've heard and from what I've read. But I said to the group, do you know how I'm going to resolve that? Do you know how I'm going to find out the absolute answer? And there was 2 people in the back. They might have been married, but there's 2 people in the back that said, oh, you can call EY. Yes. During the break, I'll call EY And I think I'll confirm my answer. I think that financial planner might be mistaken. that financial planner of that participant was mistaken. But EY is a wonderful resource. It's objective advice. There's no sales pitch. They get paid a salary. They don't make money off of the recommendations or suggestions or options that they present to you. They are paid salary. And those costs, Wespath covers the cost of that contract as part of our operating expenses. So there's no direct out-of-pocket cost or additional cost to you. It's unlimited, and as many hours, as many phone calls as you'd like to make. You could begin the process by calling that number, and then they'll likely recommend that you set up an account with at that Wespath.EY Navigate to help that consultation process go on, move forward in a good way. Consultation topics, here's just a couple of samples. Probably the biggest one here that I see would be electing life stage retirement income. What does that look like? What's best for you? Which of those three options or all of those options best for you? They can help manage your estate, develop that estate plan. A lot of clergy, when they retire, buy a home. They can help explain that process to you, help you navigate that process. So these are just some sample consultation topics. There's really no question too big, no question too small. You get to work with the same person. When I log into my account, I get to see the picture of the EY financial planner that I work with. So that's, I think, pretty cool. You can also set up a consultation with one of the benefit educators. This shows that our communications team has a sense of humor because they put my picture in this. But you can register for a consultation at that link. We like to send out a GoToMeeting, which is similar to Zoom. We can then see each other. We can also then share your account in Benefits Access and walk you through all of the questions that you may have. We also secure the call, so we'll ask some questions based on you to ensure that we're chatting with the correct person. So some action planning, some homework. If you're not registered for Benefits Access at this point, we ask that be your first step. You can go to benefitsaccess.org. It takes 5 to 10 minutes. If you're retiring this year, that's vital. That's very, very important because you're going to make all of your benefit selections there. And next would be to review all that information, all your information, to make sure it's accurate, including your clergy service record. If you're married, check your spouse's information, check your beneficiaries. Over the last couple of months, I've bumped into or I've met some clergy during those consultations where we went and looked at their beneficiaries in their Benefits Access account, and there was none listed or they weren't accurate. So make sure that your beneficiaries are who they should be. If you have a will, make sure your will, your beneficiaries in your will also match the beneficiaries in your Benefits Access account. Take a look at your life stage investment management profile, run a projection. I love running projections. I probably run a projection on my stuff once a quarter just to get an idea of what that looks like. Probably overkill, but it's a process I like to do. We can also run a projection during the consultation and send that to you, and definitely review it and look at the different options. EY is a wonderful resource. Give them a buzz, and then EY Navigate is well worth the 5 or 10 minutes that it takes up to set up that call. And then consider that benefit education consultation. Our resources are shown here today. The retirement team, for those folks who are retiring this spring, they are ready, willing, and eager to chat with you. Participant Solutions, if you have any difficulty getting into Benefits Access, they are a wonderful resource. And one final plug for EY Financial Planning at the bottom. That concludes our retirement webinar. Thank you for taking the time out of your busy day to attend. We hope you found this valuable, and we hope that you'll sign up for those consultations and act on those other very important resources. Thank you. Have a wonderful day.